So why are markets falling? Well, one of the big reasons today has to do with actually the Bank of England. So last week we saw the Bank of England report wonderfully juicy inflation data that came in substantially higher than expected. The biggest problem with the Bank of England was specifically that core inflation had risen substantially and unexpectedly. It was already only moving up, only trending down slowly, which isn't great. But the surprise move up is leading markets in even America to start questioning, is there a potential risk that we could see core inflation in the United States resurge? And yes, there is that risk. So far, there are not leading indicators of that in America, but absolutely there is that risk. The Bank of England is dealing with a lot more inflation across the board than what America is, with inflation roughly twice what our inflation levels are. But take a look at the chart here of core inflation. And what you're going to find is this chart goes back just over 30 years. And this chart really shows you how while we peaked out on core inflation and we started trending down on core inflation, what ended up happening on the right side? We got this explosion of core inflation again off to the right. This led the Bank of England to just raise rates to 5%, their terminal sort of equivalent of the Fed funds rate. They moved this up 50 basis points instead of the expected 25. There was only a 30% expectation that the Fed in England, which is the Bank of England, would raise rates 50 basis points. We got 50, even with only a 30 basis point expectation. Here in America, we would have probably gotten some kind of Nikki Leaks heads up warning about this. However, now what you're getting is an expectation that rates are going to go from 5% all the way up to potentially 6 or 6.25% in England, as they fight inflation that's substantially higher than ours. Consider their headline inflation rate is 8.7%, and their core inflation rate, which strips out the more volatile food and energies, up at 7.1%. Kind of scary. Not something that the Bank of England should look at lightly. Now, when you look at differences between the United States and the Bank of England, the Bank of England's inflation expectation rates are also substantially higher than ours. Their inflation expectation rates, while they've come down from about 6.25% for forward-looking inflation expectations, have only come down to just above 5.6%. This isn't really enough to convince any kind of pause in England, let alone rate cuts. In fact, you're going in the opposite direction in England. And it's somewhat of a concern because, again, people in America are even wondering, is there a risk that could happen here as well? And yeah, again, absolutely, the risk is that could happen in America, and that is not something markets are pricing in remotely right now. The largest risk we face in America right now seems to be that, maybe rates will go up another quarter or 2 quarters, so a half a percentage point. That isn't something that is even fully being priced in right now. Though, of course, yesterday we had Jerome Powell, who reiterated the summary of economic projections of the FOMC meeting last week. And unfortunately, that was reiterating hawkishness, whether that was through some form of pact with the hawks over at the Fed or Jerome Powell is one of the hawks. Doesn't really matter. Jerome Powell reiterated, if the economy keeps booming essentially the way it is, we could be looking at 1 to 2 more rate hikes. And this could be him keeping his optionality open, or the economy is doing substantially better here than it is elsewhere. It's also possible. Right now, the market's expectations of Fed terminal rate are 5.29%, which usually what you'll do is you'll look at the difference between where we are now, 5 and the upper bound, 5.25, and you'll say, okay, well, if we're going to be in that range, we should be at some kind of terminal rate expectation of 5.125. We're sitting at 5.29, so that's really a way of the market telling you, probably pricing in at least one more hike, since we're at least half of that more than that 5.125. So at least one more priced in. Right now, if we look at the world interest rate probability, what we'll find is we're actually now getting a sort of newly molded shape of the curve that shows a terminal rate in America coming closer to November look at this. So this chart keeps evolving. It seems like on a weekly basis we get a new version of this chart, a new manipulation of what we should actually expect. Remember that if we go back to March, we were expecting 175 basis points of cuts by the end of the year. Markets have completely removed that risk. Now, what's really remarkable, or I mean the benefit of a potential rate cut, right? It was removed by markets. We're not expecting rate cuts now until at least January, at least according to the world interest rate probability chart here. Instead, we're looking at this could potentially be a pause here in July, followed by maybe a rate hike in September and November. And potentially, this is not necessarily to say that the Fed would actually hike in November and then cut in December. While it looks that way, and it's definitely possible, it's just a way of the markets assigning probability, saying, well, we think we'll probably be at a 5.25 cap by December. How we arrive there is a little distorted by the way these bar charts are created. But anyway, what's fascinating is as we moved from March to now, here in June, about 3 months and a week after the banking crisis, what we've actually seen happen is we've seen these terminal rate expectations move up, and we've seen rate cuts get unpriced, and the market went basically straight up. So why then is the market falling? Well, I think it has a lot more to do with two real fears. One fear being, oh my gosh, if core inflation can skyrocket like it just did in England, then maybe that could happen in America as well. If that happens, the Fed's not going to be talking about 1 or 2 more rate hikes. They're going to be talking about 1 or 2 more percentage points, which basically would be 4 to 8 more rate hikes. If we had that sort of disanchoring of inflation here in America, that is, which we don't. And again, no leading indicators of that now, but who knows? Maybe there were plenty of leading indicators as sort of a black swan in England as well, although they're not as easy to identify even now. More importantly is this fear of, okay, well, if the market's already run this much, maybe now it's time to begin hedging. And that is some of what talk you've seen over the last probably about 10 days really pick up a lot, especially after last week's OPEX. And part of that could be contributing to some of the pullback that we're seeing now, is that, hey, maybe now it's officially a good time to start hedging and stop contributing to sort of the bull run, if you will. Take a look at what we had from, this is from Goldman Sachs, just Tuesday morning. Tuesday morning, before the red actually started coming into the market, these kind of discussion pieces were starting to get more normal. That is, hey, look, there's a limit to how high we think the S&P 500 can realistically go this year. Are we really going to hit all-time new highs by the end of the year? It seems like a little bit of a stretch, right? And so Goldman Sachs gave the S&P maybe another 3% run by the end of the year. And while recent data is indicating that disinflation is underway, maybe we've overextended a little bit, especially with forward EPS and price to earnings looking a little bit historically stretched. For example, if you break this down into 5 particular reasons, you can see here positioning is no longer a tailwind for the U.S. This would be maybe not necessarily based on the shares or the level of underweight or overweight people actually are, but rather this positioning of, hey, we're becoming bullish, right? It's the sentiment positioning. And then you've got equities already pricing in optimistic economic growth. That is definitely happening, especially in the software space, in my opinion, where you're getting these beliefs that artificial intelligence is going to lead to this massive amount of profit for software. I'm not convinced of that. I do think the chip investments will continue to do very, very well, but I'm not convinced of those software investments. Equity valuations elevated versus history. In fairness, this does compare to a trailing PE ratio, though, which generally isn't the best idea since, of course, we've had lower earnings over the last 12 months. The narrow market breadth or rally is another way. I mean, the narrow market rally is one way of saying breadth has been very, very narrow. That's basically, in English, Hey man, how come out of the S&P 500 there are only 7 stocks that are basically carrying 90% of the returns? So you're getting more of this concern that, wait a minute, we're starting to get a little crowded on the bull side. It was just maybe Friday or so that I was making jokes about how it's starting to feel like if the bears are coming to flip over to the bulls, is it time to become a bear again? Now I don't actually think it's time to be longer term bearish here, but I would expect some form of short term volatility, much like what we've gotten. Honestly, I expected this volatility a lot earlier, so I was wrong about that. I thought the volatility would have come much sooner than now, as we've talked about regularly here at Nike Swoosh in a volatile format, right? A volatile Nike Swoosh. Now I'll show you where we sit with the TA right now. A quick reminder: June 30th. Write it down. Price is going up, new lectures coming out for the programs on Building Your Wealth, link down below. Once again, going through, adding a bunch of value. We're actually going through all of the old lectures, and what we're doing is we're adding sort of spliced in lectures, which is really cool about that. We've done this in the past before. And so you kind of get Kevin over the time frames, which is really neat because we can look at, okay, here's strategies that work in various different markets. So it's really, really neat. And the new lectures are going to be really incredible. So stay tuned for those. Those will be fun. But anyway, let's check those links out down below. And of course, email staff@meetkevin.com if you'd like to bundle up. So look at the NASDAQ here. The NASDAQ really got rejected in your 78% tier here on the Fibonacci levels. This is probably, quite frankly, to be expected. I mean, first of all, it's very, very normal in this sort of space of the volatile Nike swoosh for us to have a rejection on the fibs. In fact, we've basically always gone back to the prior fib levels. And with the exception of the bottom one here, which I suppose you could argue we got rejected before we ever really broke out, consistently we got rejected, so I suppose maybe not even without that exception. As you can see, we get rejected here. We tried to break through 3 times, couldn't hold it, come back down to the lower fib. Finally break through, get rejected, back down to the lower fib. We break through, we magnet to the bottom. I like calling it the magnet. We magnet to the lower fib. We don't actually break all the way through again, which is nice, but then once we're done magneting, we break through again, and then we have this smaller pullback, breakthrough, smaller pullback, breakthrough. Now we're getting that rejection over here at 373, which honestly, like if you just look at the year we've had so far, even though it hasn't felt terribly volatile, it's very, very normal for you to get rejected on these technical levels. I mean, especially if you look at a stock like Tesla, just from a technical basis, this is, let's just put it straight, ridiculous. And when we look at a trend, we are also getting, actually, you know what, we could probably go, let's see here, let's do a quick trend here. Let's grab here. All right, yep, there we go. Come on, weebs. Oh, when you do it on a MacBook, it's kind of funny because it doesn't necessarily implicate all your pushes. There we go. Oh, look at this. This is actually really interesting. So if I draw somewhat of a lower support here, and what I was grabbing is trying to get this trend right here, this as a support, this trend that you had in March, you're kind of getting rejected at exactly that level. Almost, look at that. You can't break through here, and we're ending the days getting rejected by these average candlesticks. Obviously, yesterday was red and today is red, so these candles will really start coming down on this average candlestick view. But anyway, this is reasonable. You would expect some kind of retracement. It's just not normal otherwise. Even in the software plays, right? You look at a C3 AI, you're starting to get, yesterday you had a down 9.6% day. So some of this is expected. Now, with that said, is this like, is it time to sell? Is it time to run away? Those questions have been coming up. Is it time to hedge? I mean, hedging for most, I would say, individual investors can, going into longer bull run periods, be quite expensive. If you're in an era like 2010 to 2020, quite frankly, hedging is very, very expensive because you're hedging maybe like an election or the European sovereign debt crisis or these smaller events, but it's really costing you returns over a longer period of time. Obviously, we're just now coming out of the pain of 2022, and it's still questionable as to are we going to go into a recession or not. So of course, there's more of a reason to potentially hedge now than there was during that decade of 2010 to 2020. That said, has anything fundamentally really changed? No, but that can also be said for the upside, right? I mean, yeah, we've been on more of a trend of disinflation. Wage growth is falling. Inflation expectations are stable to the low side. They're at 2.17 right now. Sure, maybe we'll get another rate hike or two, but really that Bank of England shock is creating a lot of fear right now that, hey, what if that could happen in America? Well, then you would want to be aptly hedged if that could happen in America, which obviously would be quite concerning to see inflation disanchor the way it did in England. So that said, we also haven't gotten earnings to really substantiate this artificial intelligence hope, even for the chip sector. As much as I'm bullish on the chip sector versus software, it's worth considering. These orders are going to take a long freaking time to come in and to actually fulfill. It's one thing to say, yay, we've got an artificial intelligence boom, and Intel's like, yay, we're going to spend $30 billion in Germany and $25 billion in Israel. Great. But you have to also remember, who's going to pay for that? Well, the government might pay 30 to 40% of it, but otherwise, Intel has to pay for it out of, well, their cash flow. And these are very, very expensive, much like with Tesla. I've said in the past, I'll say it again, Tesla might have to raise money because they are spending a lot, and I'm not convinced that they're going to be free cash flow positive going into this next quarter. And so the next quarter's earnings are going to start becoming a catalyst for short-term trading and short-term hedging. So I think when you put all of these pieces of the puzzle together, we're not really concerned about, okay, is it another 25 or 50? Maybe a little bit. I think we're much more concerned about de-anchored inflation. We're much more concerned about maybe too much of a pull forward for this artificial intelligence productivity boom, whether that's through chips or software or otherwise. And concerned about this lack of breadth, this shallowness that we've gotten in the market, as well as the fact that, hey, we've had retracements. This could be another retracement. So personally, for me, I look at this and I say, as long as I'm not seeing fundamental red flags that we're getting a Paul Volcker coming our way, which to some extent maybe the Bank of England is, I'm not horribly concerned about riding a Fibonacci retracement here. It's more of a, okay, let the retracement play out. That probably becomes somewhat of a buy the dip opportunity if you're optimistic on inflation and optimistic on our ability to avoid a recession. Obviously, if you're pessimistic, it's great because now, this might give you an opportunity to profit a little bit on shorts or hedges. So those are my thoughts on basically exactly what's going on in the market. And I wouldn't be surprised for this to really take through earnings to play out, which to some extent, if you start getting retracement now, maybe you sort of pre-punish Q2 earnings. That's happened in previous cycles before, where the pain comes right before earnings, and then all of a sudden companies report earnings and people are like, it's not that bad. And then you get this sort of new energy into a rally, and that could potentially push you to the next level. So again, obviously, who knows? I mean, we're trying to make educated guesses on what's happening, but that's really what they are. Because that's the beauty about the stock market. We don't have all the answers.
Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by